All right, episode 4 of the More Doors podcast. Today, we are going to give you our observation of the state of the market. We're going to get started right now. All right, welcome back to the More Doors podcast. We're excited to have you guys back. This is episode 4. And if you go back and listen to the first 2 episodes, the first one is breaking down who we are here at Deep Blue Capital. I'm joined by my partners, Matt Buchowski and Brian Force. And the second episode, we did our case study of a property that we acquired in Waco, Texas. So you'll definitely want to go back and listen to that one because we really get down into the nitty-gritty of what we were looking for when we acquired it, how we did our underwriting, our due diligence, and the financing that we did on it, and kind of how it's been going. So we definitely had last week was some great numbers on it. I think we had 13 leases, 8 renewals, 5 new leases come in. So that property and assets at this moment is going really well.
Yeah,
so
it was a good week.
So it was a great week. But today, what we wanted to break down is really we've got this kind of two sides of the coin in the market, right? We've got investors, and Brian and I just met with a longtime property manager who is on one side of this coin where he's all in cash, just waiting for everything to hit the fan. And then you've got this other side of the coin, these investors who are just looking at deal flow, and they believe that if they acquire it correctly, they believe if they poke every hole in the deal to try to protect themselves and their investors, that it's still a good time and opportunity to buy. Yeah. We are going to talk about some Q4 and Q1 stats, as well as some of the mistakes that we're seeing some of these investors that have made. We're going to armchair quarterback it for a second, as well as deals that we are seeing. And I do want to bring up, there's an article that we want to discuss that an investor out in Houston that raised a lot of money. I don't know how much. I think it talks about that in the article, but it was a lot. Matt, do you remember roughly?
I don't know the raise, but it was like 3,000 units.
It was like So this is a big raise, and it happened in 21, I believe, and it was already been taken over by the bank.
Yeah, it's unfortunate.
And some of the landmines that again, we get to armchair quarterback this one, not throwing any shade, but just maybe where the missteps had happened. Mm-hmm. So yeah, let's kind of break this down, the state of the market right now. Brian, if you want to jump into that.
Well, I think we talked. There was one stat that I think we're going to get into, but off the top, deal flow is back, right? And it's funny how these things, the multifamily and residential side, can sort of mirror each other in some subtle ways a little bit. Like, remember when wholesale deals disappeared for like 8 straight months? Yeah. Like your inbox wasn't getting flooded with 50 new Western deals every single day. Yep. And then just like that becomes an indicator of where the market is. Like if wholesalers don't even think they can make their deals work, like, whoa, like we're way off. And it was the same thing with syndication deals. I mean, we're all LPs on deals, and we used to get, I'm sure you used to get dozens of opportunities coming through your inbox on a weekly basis. And for all of Q4 and Q1, it was just deal flow wasn't there. And what was there that came through, the buyer and seller expectations were wildly divergent. And so deal flow, it seems like, is starting to pick up again. Now, we're going to, at some point, I think we're starting to see this, buyers and sellers start to come to the middle again. It hasn't quite happened yet. We're looking at a lot more deals right now, which is a great indication of things to come. We're still having to be very prudent and conservative in our underwriting. And I think that because so many crazy deals, crazy is maybe not the right word, so many deals with a different variable set were done in 2020, 2021, and 2022, we're still having a little trouble coming to the table with some realistic expectations. But I think that the first indicator is that deal flow is back, and that's good.
Yeah, I think deal flow is back at some level, right? I don't think it's quite as high as it was in early 21, really through the end of 21, it was just crazy.
Yeah.
You were seeing deals that were being held for 12, 18, 24 months, cap rates compressed, interest rates went down, and they were going to take a couple of million off the table by just exiting really quickly.
Yep.
But if you look at, there was some data published recently by RealPage. I don't know if it was Jay Parsons or Carl Whitaker. By the way, if you're listening to this, go follow both of those guys on LinkedIn. They're some of the best multifamily economists in the business. There was a stat published very, very recently about Q4 and Q1 having the lowest multifamily transaction volume in like decades.
Really?
Right? So I think there's probably there's a whole episode that we can talk about why that is. Mm-hmm. But I think that just goes to show that the easy exit on a lot of these properties isn't a reality right now.
Right.
And because of that, there's just fewer transactions. Now, there are deals, right? Or let me say that differently. There are opportunities, yes, and there are listings. Maybe not so many quote-unquote deals, right? We're seeing definitely an increase in days on market. The days of having a deal sent out to a list from a broker, and then 3 days later a call for offers email being sent out, those are fewer and further between, if at all, right? And what we are seeing an increase in is the quote-unquote off-market or pocket deal. Right? The whisper, right? And you call a broker to follow up on a deal, and they ask you what you're looking for, and you tell them, and they're like, well, I know about this deal, and it's off-market, but I can get you a look at it, as I have a relationship with the guy. And you dig into the financials, you can see why it's off-market as opposed to being widely publicized.
Yeah.
So I think there's deal flow out there. You got to look for it, and it's definitely nowhere near the way it was, but it is picking up a little bit.
Are you starting to see, because you do a ton of the underwriting, I try to help on the first pass and everything, but I know that so many of the deals that were done the last few years that are probably being a little bit whispered right now is because rent growth projections were just, at the time, seemed on point, and now they've just proven to be wildly unrealistic. In fact, I think going forward, we've talked about this a little bit, you might actually need to be building in rent. What's the opposite of growth? Shrink?
Decrease?
Projection, rent decrease projections, right? And stress testing.
You don't even know how to say it because it's been
so long, right?
All we've been doing is raising rents and raising rents. That we've forgotten that rents can actually decrease and go down, which sounds crazy. And I want Matt to answer that question, but we're seeing that because Matt, a lot of this decrease or the compression in rents is because one, there's more construction that's coming online, right? I mean, how long have we been hearing? And by the way, before we get into that part, go to deepbluere.com.
Deepbluere.com.
Just sign up for the newsletter. That way you can get on our list. You can see we'll send out any of the deals that we're analyzing and any opportunities, especially if you want to learn more about how to become a limited partner in some of our investments opportunities in the future. But how in the past, how often have we seen or heard the studies that there's not enough housing? We're having housing shortage, whether it's to buy or to rent.
Yep.
And then all of a sudden, people hear that, and then what happens? Construction starts to take place. We started to analyze how many permits are being pulled versus how many construction starts, and then all of a sudden they start coming online.
Yep.
But it's months and or years down the road, and those projects were started back in, now we're having to look retro.
Yep.
Instead of trying to look forward, and a lot of these construction starts or a lot of these constructions that's coming in line, they base their model, their financial model off of the current rents and building in rent growth.
Yep.
Right?
Yep.
And they didn't factor in that probably their construction costs ran high or their construction ran long.
Yep.
I think one of the things to just speak to that and maybe to make one little addition is, and this is what I think is getting some deal makers in trouble right now, is all we ever hear about is needing more housing. But also, to add to that, what we really need is more affordable housing.
Yeah, absolutely.
And that's the caveat. And you see this in the single-family space for the last few years. They just weren't building homes for first-time home buyers at all. Asset prices were continuing to move up. Money was cheap. Let's go build the baddest houses we can, baddest houses with the biggest, baddest margins, and just ride that out. Nobody's building for the affordable entry point.
Agreed.
And it was the same. Look at the stuff people are building. It's all class AA, sick as hell, right?
Yep.
And all of a sudden you get into an economic environment where that's not really what people are looking at. And you did the deal at a place where you'd have to charge an arm and a leg for those units. There's not as much of a market for that anymore.
Agreed.
And that's where a lot of the trickle down is not necessarily the new construction, because if I'm going to pay exorbitant rent, it better be nice. But the syndicators that were doing deals based on rent growth, well, now that rent growth would have them competing with brand new construction as well. So those deals are the ones that are in trouble.
Yeah.
That's the way I see it anyway.
Yeah, I think those are all very, very accurate points. I was just reading some data this morning. I think there's been 55,000 units added in the Dallas Metroplex in the last 10 years.
Wow.
Or last few years. There are certain pockets of the area that have seen, I think, an increase by 10% in the number of units coming online. I think just in McKinney and Allen, according to some RealPage data I recently saw, that there are 9,800 units that have been delivered this year or are on schedule to be delivered through the end of 2024. Wow. And that's just in McKinney and Allen.
Yeah.
Right? When you expand that, it's huge, right? So you have kind of a bunch of things coming together at the same time. Money was cheap when those deals were first imagined and put together, right? Then you have, to Nick's point, construction costs went through the roof. Mm-hmm. Now we're on the cusp of a recession, if not knee deep in it, right? And there's a ton of other A-class competition out there from all these other guys, right? And that's putting a lot of pressure on the top end of the market. What we're seeing, though, is that B-class properties and even the C-class properties that me and some of my other partners own, performing very, very well. Right. We're actually seeing that trickle down take effect. Right. So I think it's going to be very interesting through the rest of this year and into next year from a rent growth perspective. But I think you're going to start to see it pick back up. Yeah. Right. We cannot. I'm not going to speak in a blanket term, but I don't believe that this rate of new construction will continue. Mm-hmm. Right. And I think to your point, if there is somebody's going to figure out how to build, I don't want to say affordable housing, but entry-level housing, right? That would be considered B-class today. Yeah, and I think when somebody cracks that code, maybe it's the three of us, who knows? When somebody cracks that code, it's going to be a hot commodity, right? Because you start to see some of these rents at $250 a square foot in our area, $3 in some areas, and I don't think that sustains for a long time. That's a very, very select group of the market.
Is anybody out there right now trying to do new construction B-class? We might have just some more affordable, right? Yeah. Maybe the not top end finishes, but just
that's what I'm saying. Some sort of affordable workforce mid-tier housing. Yeah. If you're interested in talking to us about that, go to deepbluere.com.
Yeah, send us a message.
Well, according to Rent Cafe, and this was updated at the end of February, that the average rent in Dallas is $1,577 for an average of 848 square feet. So that puts us at $1.85, $1.86 a square foot.
That's an average for the entire Metroplex.
Yeah. No, that's just for Dallas.
This is
high, just Dallas. And so if we break it down, the rent, again, this is from Rent Cafe. The Dallas, Texas apartment rent ranges $701 to $1,000 a month. It's only 12% of Dallas apartments rent in that range. The majority make up between $1,001 and $1,500 a month, so that's 44%. Then you've got $1,501 to $2,000. That makes up 27%. 17% is over $2,000 a month. Wow. So really, if you really look at the majority, we're looking between $1,000 to $2,000 a month, and we probably are going to fall in that average range of that, probably around $1,600 to $1,800.
Yeah. I think where we're going to see a lot of growth, or rent growth, I should say, is there are certainly pockets in our area where the median household income is still way above the average rents in that area, right? For certain asset classes, right? So we're going to tour a property later on today, where there's, if you look at the average, the median household income compared to the rents that they're collecting today, there's probably still 20 to 25% upside, right? Now, we can't just go in and raise the rents like that. We'll create a mass exodus, but there's still upside like that. So if we run it smartly and build a loyal tenant base and take care of them, I think we can realize that over the course of time.
Yeah, there's growth there. And I think that's, to your point, I think that's why a lot of syndicators are having such hard vacancy issues right now with some of their stuff, is because their projections were based off rent growth that had to accelerate really quickly in their projections. And now you're seeing those vacancies show up because you're trying to raise rents 10% a year, and all of a sudden that just can't happen.
Agreed.
And so you've got to build your plan smartly over your hold period. And if you don't do that, you're going to run into really bad cash flow issues right up front.
Yeah. I mean, I think also the market that we're in was very forgiving. Here's an example, right? So we acquired a couple of assets in Arlington at the end of 2021, and we had built into our model, we were going to turn all the units, and that we built in a 1 month per unit into our pro forma, right? So they were going to turn it around, we were going to market it, and we were going to fill it in a month. Under the assurance that the construction was going to take 2 weeks. The construction actually ended up taking 62 days per unit, right? Wow. So we were more than double.
Quadruple.
Yeah. We were 4 times the initial assurance amount, twice what our pro forma was. But the way we offset that was because rent grew in Arlington so quickly that by the end of year 1, we were achieving our year 3 pro formas.
Wow.
Right? So the market was very forgiving. It's not so forgiving right now. Right? And you may not get lucky like that. So I think the other thing to think about too is, there's been a lot of layoffs in the economy, right? I would say that based on what I've seen, probably the heaviest hit areas are A-class employees.
Sure.
Right? You see a lot of these big technology companies laying off employees, right? I think Meta announced starting another layoff today. So the B and C class, kind of working class, right, has been largely, I don't want to say unaffected, but less affected so far. And hopefully that continues.
And I mean, if affected at all, and maybe in a positive way, I mean, that is where living expenses are high. And one of the first things that people start to talk about when they're starting to tighten up their budget is, does it make sense to, especially if they're renting, does it make sense to pay this every month, right? So, transitioning into a B-class property might be more sensible for a lot of people right now. So I think if you buy smart and you have the right projections and you underwrite and stress test well, that's where the opportunity is going to come from. What do you think about, your just overview thoughts on the deals that we're seeing right now and the quality of what's coming through and maybe the realisticness of the deals being put out there? Are we getting closer?
Yes and no. Yes and no. I think there are certain deals out there that are making more sense now, but I think there's still this gap between performance expectations versus what the economy is telling us we can do. Right, so I looked at a deal last week, and I compared 2 different sets of data, and the rent growth assumptions were vastly different.
Really?
Vastly different, like 1.5% from one data set and 6% from another. Right, that same deal, you underwrite that 2 ways, and you're getting 2 wildly different outcomes. Right, I think that if you look at the T12s now, they're largely adjusted for inflation. Right. So those costs have gone up, and so I'm not necessarily so worried about underwriting go forward expense growth,
right?
Like I was a year or 18 months ago. But I think there's still a lot of very, very presumptuous or wild assumptions being made on exit caps and rent growth and expense management, and you got to look at those very, very, very carefully. And look, no offense to the broker underwriters out there or anything, but if you're putting your name on a deal, whether for your portfolio or you're going to go raise money, make sure you're doing your own due diligence, not just taking what's in an OM and putting it into your model and making sure you get the same outcome. Right? There are a lot of different data sources. There are a lot of different opinions. There's a lot of different sources of data. I think I just said that twice. And you got to make your own decisions.
Well, I think you just got to see the broker's underwriting as just one part of the synthesis, right?
Yeah.
Almost, that you take that as, hopefully some realistic vision of what they've been spending.
Yep.
But you've got to synthesize your own projections outside of theirs. I really think the only thing you need to take from the broker is what are the actual costs that they are incurring right now, and then probably also see that'll give you some insight into some costs that may be missing that you might need to expect to incur, right? We planned on talking about this too, right? So a lot of deals that were not working or maybe only worked because of things like reduction in on-site staff and stuff like that. Like that's a cost that starts to get shriveled down a little bit in a T12 that the next buyer might need to have that in there, right? And so you've got to get good at taking what is available information-wise, but also projecting what your needs are going to be to come up with your own underwriting.
Agreed. And it's funny you should say that. So I have emails in my inbox going back to like 2018. So there were certain deals that hit the market that I remember, right? And I go and I pull up the old OM.
Yeah.
And what I see in a handful of situations was the deal 3 or 4 years ago had a bunch of payroll, right? The deal that I'm seeing now has no payroll, right? And at the same time, you see vacancies much, much higher, right? CapEx in turn and repairs and maintenance is much, much higher. And so what that investor did is they're like, okay, we're going to find value, quote unquote value add, by firing the on-site staff and having a third-party manager just operate from afar, which can work, and we have some great property management teams that do that, right? But it doesn't work all the time.
Right.
And especially when you get into that 60, 70, 80 unit number, you need people there. There's always a question. There's always a repair, right? And when the tenants don't get that service, the performance of the whole property starts to come off the rails.
Trying to charge higher rents.
And you're trying to charge higher rents, right, to an unhappy tenant base. So then they start to leave. So then you almost create your own nightmare because you need to have people there more often just to stop the bleeding.
Exactly.
Right? And now they got to exit those deals because they're not performing. They have some bridge debt that's coming due or they're coming up for, the term's about to expire. And the deal just looks kind of ugly, but they still want top dollar for it.
Yeah.
Right?
I think that's the situation we're starting to see a little bit more and more right now. I mean, you hit the nail on the head. I don't know. It feels like, and I heard a property manager that has about 25,000 units across the country under management say this on a different podcast recently, like summer, fall is when you're going to start to see a lot of things hit where the bleeding has to stop for some of these deals and they have to dispose somehow.
Yeah.
Or they go into receivership or something, right? So I am kind of, I'm not the guy that's like, it's all doom and gloom, we got to stay on the sidelines forever, because then you're trying to catch a falling knife. It's like, how bad do things need to get before you jump back in? Because a lot of times those are the same people that tend to be like, when the market is really hot, they want to jump feet first in, which is also a bad mindset to have as well. You need to just be prudent with the variables that you have at play. But I do see.
Well, it's like they jumped in. I mean, we saw a lot of people jump in 21.
Yeah.
And would we agree that was a good time to jump in, looking back? Sure, I guess, because, just the natural momentum helped them.
Yeah.
There was zero skill set. And I was reading this article about it. It's the Wall Street Journal about the housing bust comes for thousands of small time investors, and in it talks about the syndicator that lost in Houston lost over 3,000 units,
right? And
this capital raising company, the syndication company, raised millions of dollars. And a lot from, it was $75,000 buy-in. So as a lot of people, it was on the smaller scale. And from day one, they closed on it in 21. It was floating debt, so floating rate immediately.
From day one.
But their interest rate back then was 3.75%.
Yeah.
Right? So I don't think, how many people, we've all talked about it, raising rates. Who would have thought it would have gone that quickly?
No, it is part of that it was uncapped. I don't know if it says that.
It doesn't say it, but I'm assuming it was, because my understanding, from this, it was actually, there was a lot of loans. They got a 3.75, but those types of loans in 21, So here's his company had taken out commercial real estate loans that carried floating interest rates and were adjusted each month. So so there was no cap on it. These types of loans in 21 offered initial rates as low as 3.5%. And then ultimately they couldn't, that company, that the management company that was managing all this, they could not raise rents fast enough to offset the increase in monthly rent or a monthly the interest rate adjustment. Yep. And so, what you've seen from 21, these investors who now are saying they're going to wait on the sideline for everything to fall, should they have said the same thing back in 2020 and 21? Because ultimately that necessarily wasn't the best time to invest. It was just kind of this, there's a lot of money out there and everyone just dumping it in. And then that's what was propelling everything, right? And then there were shortages, then everything just went crazy. And it was kind of this, it was the momentum of social media, is the momentum of the energy. Yeah. Now, just like the momentum of the negative side, we're a lot of people are riding that wave of gotta wait on the sidelines, when ultimately investing in anything involves looking at every angle, looking at it intelligently, trying to predict and project the best outcome and working a business model, because this is a business. Yep. And everything that when Matt would bring out his underwriting, we would poke holes in it and we would say, what about this? Yep. Even one of the questions came up that Matt had asked when we were doing our underwriting calls is, what happens if there was another COVID type lockdown, right? Yeah. How many people before COVID were asking those questions? Yeah. No, right? What were they asking? I don't know what they were kind of asking. They were probably asking what happens in a recession, everyone loses their job. Yeah, that's probably it. They probably weren't worried about interest rates back then. So now you're having to worry about, you're trying to underwrite a deal flow of a potential, God forbid, another type of government lockdown or shutdown. I don't think that would happen. Now you're trying to underwrite in the next couple of days, as we're making this recording, is the debt ceiling. Yeah. What happens if we default? Right. I mean, if we default, what happens to rates? What happens to anything? Yeah.
It's a good question. I have no idea. You are at a baseline, though. You're saying exactly what every investor should have in their mindset, and that is the market itself doesn't dictate whether or not it is a good time to invest. And this is the issue that I think a lot of investors run into, is they allow the market to be the thing that decides whether or not it's a good time to invest. And that's not really ever the case. The case is the things that you need to be aware of and project for are different in different environments. And the price that you need to be able to pay is different in different environments. So was 2021 a good time to invest? Well, it's a good time to lock in a low interest rate, right? And if you locked, you would probably have a prepayment penalty. And if you didn't, I hope you bought a rate cap, right? Like we did deals in 2021 and we cap rates and they're secure. And you could go and try to get all the juice out of the squeeze of the market. This will never change. We're just flying high. And then you lose 3,000 units, right? Does that make it a bad time to invest? It makes it a bad time to make that particular mistake. Is it a bad time to invest right now? Well, it's a bad time to project 6% rent growth. And it's a bad time to pay a price for an asset that is contingent upon that. Yeah. But it's never a bad time to invest. The variables just change.
Yeah, I think, and Matt would probably echo the same thing. If you're investing in an asset or development or project that you're trying to raise rents and hoping that the market is going to support it, then that's probably not the deal you should be investing in. Mm-hmm. Ultimately, what you're looking at buying is something that's probably mismanaged. The Waco deal that we bought was a mismanaged property. Mm-hmm. We saw that the rent growth that we could have was actually what the current market value was supporting. Mm-hmm. We weren't pushing rents. Right. We were pushing it up to the current value.
Yeah, we're not trying to bring it above market.
Right. I am selling my own deal of something that ultimately does not play into my strengths. We purchased it. It's 24 units. It did not play into my property management strengths at the time. We're selling this. We'll get to closing. And ultimately, the new operator has the experience of operating those types of units for even government housing. Right. And that was the strength for this guy. It wasn't the main strength for my management team. And it just became a headache for us. Yeah. So ultimately, this person is getting a pretty good deal on something that ultimately was was mismanaged because it wasn't towards our strength. And that's where it's coming into your operators or your syndicators. And it talks about this in the Wall Street Journal, is that in 2012, there was this change that really surged, opened the door for syndicators with a law that made it easier to market real estate investments online. And that's where we saw this huge growth in syndications, right? And ultimately, and something that we're really changing and we're really honing at Deep Blue is that we're not just here. A lot of these syndicators, even if it goes under, the deal goes bad, they still make money.
Non-recourse.
Yeah, that's and who's left holding the bag? They're investors.
Yeah.
Right? And I personally think that's wrong.
Yeah.
Right? If you're just raising if the way that you're designing to make money as a business is through only the syndication, the asset management, the capital raise fee, everything else, and you don't care if that deal is successful or not, I don't know. That speaks volumes to the character.
Yeah.
A lot of people out there like that, though, man, and there's a lot of easy money for a long time. You hit the nail on the head, though, as far as one of the things, and we discussed this earlier. You have to change, I think, the order almost in which you do things right now because of you need to have experts even at the underwriting phase. Before, you could just look at every other deal around and kind of project rent growth and things like that. We're talking to our property managers on deals that we're not even through the first pass of underwriting on.
Right.
That they have, like we were looking at another deal in Waco, and we went straight to our property manager, who is an expert in that market, and going, look at this. Is it even, like, are we even in the ballpark? Let's talk realistically about rents. Like, we're not even trying to underwrite stuff right now that has any sort of, this has to go right for it to work. And we're going to our team beforehand, before we even waste our time diving in, is this contingent on higher rent growth or another variable or whatever? Whereas a lot of syndicators, they just go and get the deal, and they'll build the team afterwards to manage it. And that's the wrong way to do it. And more than ever, you really got to rely on your team to help you even with the assessment process to make sure that you're getting into the right deals.
Yep, absolutely.
You know?
I mean, I think there's definitely been a lot of people that have been in the I'm going to wait, right, mindset. I've also been talking to a lot of them about getting into a deal since like 2017, 2016, right?
Waiting for a while.
They were going to wait till the market cooled off. Now the market's cooling off, but they have concerns about something else. And there's always going to be that population of people, and they can go find ways to earn returns on their money however they wish, right? But I think you've got to find the deals that work for you, right? And I think especially in this market, find the price that works for you. And maybe you get beat. But I'll tell you, we closed on one last month where we got beat in April. And then by early February, the buyer dropped out and our phone rang, right? And if you put together a good case with a respectable enough price, if and when that buyer falls out, you will be remembered, right? I would say, just from a practical perspective right now, I think the days of forecasting 5% vacancy are gone right now. Right, and it bumped that up a few percentage points.
Yeah, what do you think that should be, like 7, 8, 9?
I'd say 8.
Yeah,
8. And I think you got to look at how you're reflecting that 8, whether it's 6% vacancy and 2% loss to lease, given your tenant mix and what you're going to try and do to the property, or 5 and 3 or 8 and 0. Right, I think you can't have loss to lease if your rents aren't growing.
Yeah,
right. So if you're forecasting 0 rent growth, just pad your vacancy numbers on your vacancy. You don't necessarily need to include loss to lease.
For those that may be newer as they're tuning into this, what is loss to lease?
Loss to lease is the difference between the rent that you're charging versus what the market says you can get. So if market rent is $1,350 and you're collecting $1,200, you have $150 a month loss to lease on that unit, right? Now, a year or a year and a half ago, there was a lot of deals on the market that said burn off loss to lease because rents had skyrocketed so quickly, and rents had gone from $1,500 to $1,800, and you still have a population of tenants that are paying $1,200. Right. So they're like, just go in and raise rent $600, right? And you'll be fine.
Yeah.
And then you'd have a huge churn in the complex, right? But vacancy and loss to lease, two big ones.
What about delinquency?
Good question. So I consider that part of the overall kind of vacancy allotment, right? And your bad debt is kind of a percentage of that also.
Yeah, because I was just while we were doing this, I was trying to find some data on delinquency rates, right? Because there's been some property managers we've talked to that talked about how they have experienced in the past couple of years very little delinquency. And now that I'm, some of the stuff that I'm seeing, even on my own units that I have, we've seen an increase in delinquency. We've seen an increase of having to file evictions.
Yeah.
And I was just trying to find some data on that. I don't know if RealPage has any of that we could go to and really discuss and break down. But ultimately, we do have to build that in, especially as we head more into that potential or that stronger potential of recession.
Yep.
Of one, delinquencies, then two, the cost of evictions.
Yep.
And then the cost to make ready and then get it re-rented out.
Yep, exactly. And I think that's a really good point, Nick, because you have to be very realistic with those time frames. So a year ago, I'd say a month to make ready and market and turn around a unit. Right now, there's not a whole lot of people moving around.
No.
Right? Yeah. And especially if your property if you've raised rents to the point where you're the most expensive in the neighborhood, right? I'd pad that vacancy number a little bit and expect a longer time to turn that unit.
Yeah.
Right? I'd rather do that, make a deal work by doing that and beat the projection than be on the other side of it.
100%. Just real quick, what do you guys, we've mentioned this a couple of times, right? Like if we're going into a recession, seeing massive layoffs, at least in the tech space, several bank failures, rates, almost, more than doubling in the past 9 months, or I guess a year. What outside of, what the news says, what do you guys define as if we see a recession? I'm just curious as to everybody's perspective on this.
I would like to say, and look, I'm not going to make this, I think we're already there.
Mm-hmm.
The government's not calling it one because they didn't want to call it one after COVID and everything else. They don't want to call it one because elections coming up. And ultimately, I do believe we're there.
Yeah.
And ultimately, we just have to determine how, I think that we're just trying to put a spin on it, or they are trying to put a spin on it to make us feel better.
Yeah.
Because ultimately, the minute that you admit we're in a recession, I think ultimately changes how people spend their money.
Well, sentiment is everything.
Yes.
Right. So you don't want to use that word. You don't want to use the R word because then everybody really freaks out, and that is true.
I think the thing that's been holding it back from being a quote unquote full recession is, the labor market's still been pretty strong.
Yes.
Right. And as I know some people that had been impacted by layoffs, and they've already landed somewhere. Yeah. Is it their dream job? Is it, did they get the move from VP to SVP? Probably not. But they're putting food on the table. They're covering their mortgage. They're paying their rent. They're keeping the cars.
But do we look at a recession by also unemployment rates, or do we just look at recession by how much things cost, or we talk about affordability?
That's the thing with definitions. It's supposed to be 2 quarters of negative GDP, but we had that. They're like, well, not this time.
So when you start looking at it, if you go and just conduct your own survey and ask, are people happier or people worse off than they were a year or two ago, I don't know many people that are saying, one, they're happier, or that they're making more money, or that their dollar's going a lot further.
Yep.
And so, everything's costing higher. Property taxes, you got property insurance, you got food is outrageously high.
I think they said the average grocery bill is up 7% year over year.
I think something like that. Yeah, and some parts of it are even way higher than that.
Totally.
Meat's the only thing that's down. You guys want to eat some steaks? That's like the only thing that's down for some reason. I don't know why. You can pull that up in the background, like how much red meat is down. It's like the only thing that's deflationary in the food market right now. I have no idea why.
Interesting.
Look, eggs were
$7 a few months ago.
Yeah.
It's still pretty much right there.
So that
those brown ones that you get from Whole Foods, maybe.
Yeah, those
the normal white ones, they're not so bad.
Those aren't normal though. That's the thing.
So if you just break it down, I believe we're already there, and we're just that's the elephant that we're not addressing, and maybe I'm holding optimism with that we're technically kind of in that, or we are in that, and that we do have that softer landing because the government's not admitting it. So the general population's like, oh, we're not in one. The government hasn't told us we're in one. And so we're still seeing spending.
Yep.
One, because we have to. And two is like, because we don't believe we're 100% in that. And so, does that help us have a softer landing than maybe some of these extremists out there that said the worst storm is still coming?
Yeah.
And it's going to be the worst thing that we've ever seen.
You know what? The thing I want to kind of poke at that, Nick, is I agree with you on everything that you said, but I also think it's important to keep this in context because economies we definitely have a macro economy, but there's definitely micro economies that factor in too, right? And when I look at Dallas, so I was at the gym this morning and I saw this news release that says there was a major construction project. They're taking down parts of I-45 down in Dallas to redo it or something. Like, that's not cheap.
No.
Right? And if you're looking to put dollars to work and I don't want and minimize your risk, I would look at places in governments and local governments that are still investing, infrastructure, stadiums, schools, right? Look for those things because those are typically signs that there are good things to come. There's, what is it? If you're living in a neighborhood where a Home Depot or a Whole Foods or a Lowe's is about to get built, you did it right because
or Starbucks.
Yeah, or a Starbucks, right? Like you look around and you're in
Chick-fil-A right next to one of my Airbnbs. I was pumped.
Nice, that's awesome.
So, how much value do you think that had?
I mean, at least $1 million.
Yeah,
I would think.
Yeah.
So. At least what your balance sheet says.
Exactly.
Yeah. So as we get closer to wrapping this up, go to deepbluere.com, sign up for the newsletter, and inquire if you are wanting to look at what a limited partner and investment strategy would look like. Just just sign up there. You can talk to one of us. We can talk about some of the opportunities that we have coming up, especially as we're underwriting some of these projects that are coming across our desk. We're analyzing them. Like we said, we're walking one today. We have a few more that we're really diving into.
Yep.
And we're also narrowing down what we don't want, right? So, there's certain areas that we don't want to be in. It's a higher, we're seeing that, that when economically those certain areas get hit harder or faster or quicker, and maybe subject to more extreme weather conditions.
Mm-hmm.
And so those are some of the areas that we're kind of laying out that we probably don't want to be in to make it to protect everyone's investments.
Yeah. We're literally looking at deals on a deal by deal basis,
yes.
right? And do the economics work? Is there enough room in the deal that if insurance goes up the way it has been for another couple of years, can we still deliver returns? Yep. If there's no rent growth, how many units are coming online? It's definitely deep. To pile on to Nick's suggestion, right? Even if you have a deal that you're looking at and you want to shoot it and you want somebody to come up and get on a call with you and shoot at it, like send us an email. Yep. I'd be happy to fire up a Zoom and review it with you and let you know what our assumptions would look like. I'd love that.
Yeah,
that's what I love about this space is like the pie has always been big enough for everybody.
Yeah,
there's so much synergy. So we'd love to connect with anybody who's considering doing deals and lend a hand any way we can.
Yeah, just go to deepbluere.com and wherever you're consuming this, if you're listening to this on any of the podcasts like Spotify, the Apple podcast, leave us some reviews on there. If we're not doing a good job and you're not liking this, just tell us what we could do better. Right. So ultimately, we're doing this to educate the population out there for people that may want to get into syndication. Maybe they want to make their money work for them, but they don't know where to start. Yeah. Mm-hmm. Or maybe they've heard all the horror stories, right? Like the Wall Street Journal. You can go look it up. The team in Houston. There are horror stories, and there are also stories out there of people just committing fraud. Mm-hmm. And so there's probably something holding you back, but at the same time, you do want to build your portfolio. You do want to get tax write-offs, and build wealth.
Yep.
Just talk to us.
Yep.
That way you can see what we're all about. deepbluere.com. And we thank you guys for listening. Tune in to episode 4. And go back and listen to our first 2 shows. Mm-hmm. And it's only going to get better from here. We promise you that.
We'll see you next week.
Cool.
That's right. Take care.
Thanks guys.
Boys.
Thanks, everybody.